Well, we're having a little bit of issue right now. The tariffs are definitely causing a lot of problems with our export partners, especially on the pork side within Mexico. We have that 20% tariff on the products that are going down there on the ham products. And so those are causing lots of issues. That product has to be passed on, or that extra cost has to be passed on to customers. And it can't be, right now the trade really cannot make that happen at the retail level or the food service level. So there's definitely lots of issues on the poultry side. There is definitely dynamic situations of all the U.S. markets are not open, and they have to be kind of joggled around, especially in the Chinese market. Hong Kong market are still very difficult.
Yeah. And on the grain side, it's primarily affected soybeans. Many people know that China is the largest importer of U.S. soybeans. And when tariffs were applied way back in the June timeframe, the soybean market took approximately a $2 per bushel dive. Now, a lot of that also had to do with crop condition ratings in the U.S. were just outstanding. Since then, though, however, the soybean market is quite supported. The tariffs remain in place. Soybean exports from the U.S. to China have dropped dramatically from in the 28 to 36 million ton range down to approximately 3.5 million tons. The big question is what's going to happen from here forward. The price actually is quite well supported, with futures trading in the $9.50 range on soybeans. And in reality, the U.S. and South America are projected to raise large crops, creating large stocks on hand. And historically, soybean prices should be trading down in the $7 to $8 range, but they are quite well supported because world demand is quite strong. But the tariff issue and the uncertainty about particularly China demand for U.S. soybeans will remain a question.